All right, everyone, welcome back for another episode of This Week in Charts via Carnivore Trades and Wall Street from Main Street. If you've not done so already, please like, comment, subscribe on the video. Come find me on carnivoretrades.com for swing trading alerts and analysis. Come find Jason on his Patreon for one of the best deals out there in the macro space, only $5 a month. Anyways, let's get into it. So with the S&P 500 here, we had a little pullback, kind of a stair-step pattern down. So coming off the highs here, little stair, boom, another stair kind of pattern here. Closing just below the 200 moving average and basically held the 20 MA on the little gap down and just kind of went sideways to neutral into the end of the week. A lot of the options market seemed to be, the max pain seemed to be about 448 on the SPY here. And for the triple Qs, those of you who follow the triple Qs, it looked like 350 or so was max pain as they pushed it below that level. As far as the Spiders Weekly is concerned, not a terrible pattern here. You did hold the 50-week moving average, and you're just pulling back off the highs. Nothing terrible when you see, a market move up that quickly, and, it's not terrible to see a pullback there. So nothing really wrong with a little bit of backing and filling, which I do believe that is what the market is doing now. And same thing on the triple Qs, although the triple Qs are a little bit weaker here as yields put pressure on those high growth plays. But triple Qs you can see coming into this necktie of the 50 and 20 week moving average and pulling back off of that. So getting a little bit of a reaction. The Dow, via the diamond here, holding up really well. So the consumer staple stocks here, you can see this nice thrust here and a nice upright bullish flag pattern potentially. But these consumer staple stocks, blue chips, the Coca-Colas, the Pepsis, the Procter Gambles of the world, typically do better in a higher rate environment, and they're more defensive plays, kind of like recession stocks, which is, something that's a hot topic right now. So these stocks are getting money flow. As far as the Russell 2000, this has been the weakest of the major four indices, and still has this inside red bar here that we are still kind of chopping inside of. Same thing on the monthly. So continued weakness here from the small caps again. When you have more of a, when recession talk is dominating the headlines, small caps are not typically going to perform all that well. All things considered, it does have some support in this range around 195, so maybe it fills this gap, but overall it can still get a bid. And I think that the markets overall can still make another thrust higher. At some point, they still maybe need to do a little bit of backing and filling. We do have OPEX this week. It is a shortened trading week as Easter is observed next Friday, so bear that in mind. But we'll see what we get out here, and currently I don't see any major problems here with the market. It does seem like we're just having a nice pullback off of a pretty sizable thrust that we had in late March to early April. All right, anyways, so let's flip over to yields here. So yields just continuing to rip higher pretty much every single day. Look up, gapping up. 10-year at 2.713. It is into some resistance though. So look at this monthly 200 moving average and that red bar right there. So it doesn't mean it can't get a little bit higher. A lot of the times when you have momentum like this, you can overshoot these levels, but yields going parabolic. The 30-year is very close to my target. I've been giving you guys that 2.8 target on the the 30-year, and we are very close to that. So 2.746 there on the 30-year yield. We could possibly get up to, even 3%. On some type of an overshoot. I wouldn't rule that out. But overall, yields are pretty long in the tooth. But, this is the kind of environment that we're in right now. And, when you have runaway inflation and, supply chain problems, this is kind of the nature of it. And, the Fed is dialing back, although not completely dialing back, but they are a little bit. And, this is kind of what's happening with the bond market right now. All right. Speaking of rates, let's take a look here at the 210 spread. All right, so here is the yield curve, 2s and 10s, and let's zoom in on current time. So we did get very close, but we actually, technically inverted very briefly, and then we got a bounce. So if you'll recall a few weeks ago, when we looked at this last, I did say they'd probably defend the the inversion at least once. So they did. We got inverted, and now yields are starting to move back up, which is helping financial stocks a little bit. Or excuse me, the spread is starting to expand a little bit, which is helping things like financial stocks and so on. So it is starting to move back in sort of the safer direction, so to say. But But I think at this point, it's probably inevitable that it does come back down here on the 2 and 10s. I know 5s and 30s have been inverted, and as well as I think a few others have briefly crossed over as well. But overall, major problems here in the bond market. Let's take a look at the 30-year mortgage rate. All right, and so you can see mortgage rates are now quickly approaching 5%. I believe we're at 4.8, 4.7 right there on the 30-year fixed mortgage. So again, I mean, look at this move here off the lows. So on the 14th of January of last year, so basically a year ago, we were at sub 2.7 and we are at 4.7 right now. That is a major, major move here, historic move off of the lows, and really showing no end in sight. And I mean, maybe it does get, maybe it does stall out at 5. So that does seem to be an area of interest. But what a move there off the lows. And this is going to be major problems for the housing market. I've been talking about the home builders recently. Take a look at how far off the highs the home builders are. There's XHB, ITB, Lennar. So these home builder stocks are getting really hit hard right now. And, that is a result of these higher rates, higher interest rates, higher mortgage rates. Also HYG, JNK. So, corporate debt, high yield debt is taking a hit here. Again, the JNK, we typically follow the HYG here. It's trying to hold the lows here, but it is a pretty good rollover. So, I mean, this is not a sign of strength, really whatsoever. It's an ugly reversal here. Now it could hold the lows in the meantime, but again, just a ugly look overall here for high yield debt. Also, another indicator here that is concerning is the Dow Transports. So Dow Transports had this nice bullish pattern going here. Nice little bull flag, tried to break out and then it failed. And the transports, obviously if you follow Dow theory, that can be a leading indicator. So major reversal here and a failed breakout on the transports. Now it is into a lot of support in this zone. Probably does get a good bounce here overall, but again, there's some indicators that there will be problems with the economy as far as recession is concerned, and with the stock market overall. Now that said, I want to be very clear. And I say this pretty much every week here. It doesn't mean that stocks are going to crash right away just because we have these yields spiking and corporate debt selling off and transports being a leading indicator and selling off. It takes time. So, bear markets are, everybody thinks a bear market is just a major sell-off and it just goes straight down. A bear market's usually typically a grind, and I think that's kind of what we're seeing this year. And you can have pretty good sizable rallies inside of bear markets. So I just want to be clear on that. Just because we have these certain indicators going off and kind of warning signs doesn't mean that stocks are just going to go straight down tomorrow. So I just want to make sure that's clear. Everybody understands that. Anyways, let's talk about gold a little bit here. So gold kind of just stuck in this sideways range right now. And that's really where it's been for the last couple of weeks. It does look like, it did get a pop on Friday, but it does look maybe like it wants to come down here. You could make a case that you have kind of a sell-off and then kind of a bearish kind of inside bar here. So maybe it comes down and tests 1870, but the one thing I will say is take a look at GDX. So GDX miner is performing well, and that is a good leading indicator. So when the miners, they are a little overbought, they're still extended from some of these moving averages, but when the miners perform well and they lead the metal, that's usually a good sign. It's a sign of risk. Much like how the Russell 2000, if the Russell 2000 is outperforming, that's usually a sign of risk on. While with the miners, GDXJ, GDX, if they're leading the metal, that is usually a good indicator. Sandstorm, take a look here. Obviously, this is one that Jason follows pretty closely, but you could make a case you got a nice little trend line breakout right there on Sandstorm. So a nice move here. I mean, WPM, obviously a rock star name, FNV. So these guys are holding up really well. Newmont is holding up at new highs here. So miners leading the metal is a good indicator. Let's take a look at silver. Again, pulling back off the highs, but again, you could still make a case that this is some sort of kind of flag pullback pattern. So I don't really see any problems, and I do like what the SILJ is doing. This is putting in some strong weekly consolidation. You have a lot of resistance up here, but when you come up and you go sideways like that, essentially what's happening is shares are being accumulated to attack this resistance zone. So nothing wrong with this. I think it needs to bake in the oven a little bit longer, but I do like what I'm seeing from the miners, specifically SILJ and the GDX. Platinum, palladium have come way off the highs. I think these need to test some lower prices, specifically palladium. And copper, nice move up here, but it just has a lot of trouble with that 480 handle. But it's trying to flag up here on the weekly, still well inside of this red bar, but no real problems there for copper at the moment. Let's look at a few other things. So some of these potash stocks continue to go parabolic here. Intrepid, this one is coming into a little resistance. So I get a lot of questions about these names too. So this huge chop zone right here, that's going to be a heavy resistance zone. So right around 125, and it probably will get up there given the fact that it's parabolic at the moment. So I do expect to get up there and test that, but maybe you'd consider trimming or raising your stop or something into that zone. But overall, these stocks are just ripping higher. There's major supply chain problems with the fertilizer. I mean, and Mosaic, same thing, kind of, $80, $90. This is a major pivot high going back really a decade. So that should be resistance. Again, it's parabolic, so nothing to say it can't continue higher and it can't, overshoot. But these things are, obviously pretty long in the tooth with good reason. But just be aware that they are, pretty extended here, especially on the larger time frames. Let's flip over to crude here. So big tail candle on the monthly crude there, by the way. But right now, let me flip my trend lines back on. Right now, you have kind of this wedge pattern, a potential breakdown of that. It's kind of a steep wedge, but overall, you got this trend line here. You got below the 50 moving average. I think in the near term, there's a good chance it can get down to 85. But we'll see what kind of a pattern we get. If it starts to go sideways, maybe you can put in a bearish flag and move down to 85. But there will be a lot of support there, especially weekly chart support. You got that 50-week moving average upsloping. So that's in that range. The 20-week moving average is there as well as this major trend line going back really to 2015. I know this is a messy chart here, but this is a major trend line here, this white trend line. And, we did break out above that, so that would be support on the way down. Typically, that is how it works. But overall, crude just backing and filling. It got really extended. A lot of geopolitical risk premium got priced in very quickly. And that's why you have those parabolic spikes, and then you have to kind of digest that move. I will say these XLE, the energy stocks, are just continuing to chug higher. Now, the one thing I will say is take a look at, so this dotted red line here does represent Options X, which is next Thursday. The last time that we had that went basically parabolic up into Options X, they did sell off. And that's typical, typically overbought things will come back in during Options X, and things that are oversold will reverse and go higher. So just be aware of that. But these energy stocks, XOP, basically at new highs, OIH as well. So the energy stocks are holding up really well, and there's just lots of money flowing to that sector. Nat gas in the double top here. It's overbought. It should probably get a pullback. It may fade down a little bit. I would say downside targets would be 550, 575, $6, somewhere in that range. But overall, this secular bull does look to be intact. I love this move. I love this wedge. I wish could have been a part of that. Was looking for it to consolidate just a little bit longer. But what a breakout there! Basically going from 475 all the way up to 650 in pretty much just a month. Nice move there on nat gas. It is a little overbought, a little long in the tooth right now. Extended, does need to do some backing and filling, but no real problems here from a secular bull perspective. Anyways, lastly, let's cover uranium, and I'm gonna try and flip over. I'm gonna flip over here to trading view, because we can actually look at spot uranium. And it's a little tough to see this, but I'll try to go to a monthly here. It's such a thin market, but look at the move here. Obviously this is very representative of, just the demand for alt energy right now. And, the uranium market, we just talked about nat gas, these prices going parabolic right now due to, really underinvestment for quite a long time here overall. But huge move there for uranium over the last couple of months, and I've been talking about that. I did a video on this like last year, saying essentially that I think uranium could be one of the biggest trades of the next decade. But if we look at SRUF, Sprott's Uranium Fund, it's, a newer fund on Thinkorswim here, but at an all-time high for this issue. Take a look at, so even the URA making a nice move, consolidation here, popping up. URNM, same kind of deal. CCJ at highs. Let's look at the monthly. So monthly, it is into some resistance here, but you did do some consolidation, so nothing to say this can't move a little bit higher. The one chart I want to share with you guys. Oh, by the way, the URNM, because remember a few months back, I told you guys 60 bucks was going to be your buy area. We got right there, so pretty much a bullseye there. Hopefully some of you guys got in on that. But the one chart I find fascinating right here is Denison. So a little bit of a smaller producer. But nice little kind of wedge pattern here. You pushed through that, didn't quite confirm the breakout, but I like what it's doing. You had this sell off here, kind of a correction, and now you're moving up, consolidating. And again, like I said before, you're accumulating the shares to push through this resistance here. I like the monthly time frame here. So you got this, kind of big sell off area, and now it's just, having a nice move up and kind of consolidating. I love it when stocks and assets do this. Beneath resistance, it tells me that they want to go higher eventually. So nice little chart there for Denison. I kind of like that wedge pattern, but the monthly time frame also looks good as well. But anyways, going to wrap it up here. Make sure you come find me on carnivoretrades.com. Come find Jason on Patreon. Like, comment, subscribe, etc. And I'll talk to you all next week.